Welcome, folks. Wow, look at this crowd. I wonder if there's a lot of these folks are on break, but 75 in the room right now. OMG, I'm a little nervous here. No, I'm not. We do we have similar crowds at FX Bootcamp on a pretty regular basis, so no worries. But yeah, unusual to see this size of crowd at this webinar, so all good. First, let me remind you, the purpose of this event is education. I do not provide specific trade alerts or recommendations, but we'll take a look back at how this trading day unfolded, and we'll take a look ahead and what at least tomorrow, if not even future days, might bring. And first of all, after the disclaimer there, special thanks again to FX Straight for making this event possible. Been doing this for several weeks now. I want to say several months. When we start, like late August, early September, something like that. Been doing this between 3 to 4 days a week, and loving it. I hope at least a few of you are deriving some benefits from this, whether it's listening to me yap about things, or communicating with other traders, or just a sounding board. Maybe me serving as a sounding board. Hey, Gan. The Gansters here. So what happened today? What can I say? Risk off. Risk off was the theme. U.S. dollar index, I just saw a ticker from CNBC, the Financial News Network. The U.S. dollar index gained about 1%. Several U.S. banks down between 3 and 6%. Yeah, it's a risk off day. Interesting how this has occurred again. I don't know how many times we've seen this now, and not exactly the next day or the day after, but soon after. A European Union Leaders Summit, we get a risk-off mood in multiple financial markets. Risk-off, as many of you know, can mean things like dollar strength or yen strength, two classic safe haven currencies there. And, of course, as it pertains to the Eurozone these days, risk-off certainly can mean a weaker euro, and we certainly got that. Oh, even Michael knows when the first one was. 29th of August, really? I mean, I'm a numbers guy. I usually keep pretty good track of that kind of stuff, but I didn't realize it was then. Thank you for the reminder there. Yeah, you know what, Gam? There was a comment, or a statement, I should say, issued. A statement issued by, was it Fitch? Gam, I don't know if you caught this. Fitch issued a statement, this was a little over an hour ago. There's for those who are wondering, there's three ratings agencies, three major ratings agencies based in the U.S. You got your Moody's services, you got Fitch, you got S&P, Standard & Poor's. Now, Standard & Poor's, or S&P, they're the ones that issued the negative warning on several Eurozone countries. What's like 15 different Eurozone countries on negative watch right now for a potential downgrade. And what we're talking about here is essentially the credit ratings of countries. These ratings agencies have downgraded over time, over the past couple of years or so, various so-called European sovereigns or European countries. You've got Greece in there. Ireland's been downgraded. Portugal, Spain, and there was recently Italy, right? So, and now they're talking about, or at least one, S&P in this case is threatening, if you will, a downgrade of multiple European countries, not just one, not just two. And one of the keys is that S&P has listed amongst their negative watch list Germany, the arguably the core of Europe, the strong man of Europe, if you will. And S&P did mention last week that, and I believe they reconfirmed this after the EU Leaders Summit statement, decisions, whatever you want to call it, were issued during last Friday's Asian session. That, I mean, their review starts now. I mean, they were awaiting the decision to be made late last week at the EU Leaders Summit, and now that decision is out there. Their review their proper review has started, and in fact, one of the reasons for the sell-off on the euro today, at least according to some news wires, that was one of the reasons cited for the euro sell-off was the prospect that S&P may issue a downgrade as soon as today. Now, I don't know about that, and don't give me credit if in fact they do that. I'm just citing what the so-called word in the street or word amongst trading desks is, and that's one of the things that seems to be amongst the market chatter there. Anyway, I'm get back on topic here. I mentioned Fitch earlier before I went on this little discussion about ratings agencies. Fitch Ratings, one of the three major ratings agencies, said that, and I'll quote at least a statement provided by Trade the News, a news service we use at Ethics Bootcamp. Fitch Ratings says that after the latest EU crisis meeting, it is clear that politicians are responding to the Eurozone sovereign debt crisis through incremental improvements. And as I see, that's the key phrase there, a key couple of words there, incremental improvements. And it's not just Fitch I'm hearing it from. I mean, I've read it from several different sources, so you name it, mainstream media members, economists, analysts, hedge fund managers, whether you like it or not, whether I like it or not, the opinion it seems like seems to be a broad consensus amongst many different kinds of players or roles, if you will, that it was just same old when it came to a leaders summit in Europe. We've talked in recent webinars here about a so-called big bazooka type solution. The kind that I'm not trying to say the U.S. was all great and mighty in doing this, some 3 years ago, but, we had some more big bazooka type solutions, seen in the U.S., about 3 years ago in the wake of the Lehman Brothers bankruptcy. And, we had the TARP program and, a lot of quantitative easing. The Federal Reserve started its first round of quantitative easing in late 2008. This was like in December when I think they announced the first round of quantitative easing, as I recall. So, and it also took the rates down to ZIRP, or zero interest rate policy. The Fed first established its range for the Fed funds rate between 0 and 0.25%. I believe December 15th of 2008. If that wasn't the date, it was close to it. So anyway, many are of the opinion that Europe needs to do something of the same thing, something along the same lines, a big bazooka, a major kind of almost a shock and awe type solution to calm markets, specifically including or especially targeting the government bond markets in Europe. You mean the Italian bonds, Spanish bonds, even these days even maybe French and German bonds. And again, in the opinions of many, what's been offered up to this point has been more of what I call baby steps, incremental solutions. There hasn't been that sort of big bazooka type thing that would calm the markets and start instilling confidence and help shore up the euro. So we get the second. You could argue the second full trading day. I'm calling the last Friday the first one, the first trading day last Friday in response to some agreements and decisions made at the last EU summit. Second full trading day, and we got the not only euro sell-off, but this euro sell-off has taken us to multi-week low, which I'll discuss in a moment. And Rob says it's difficult to comprehend the guidelines to use. Well, and that's one of the sources of confusion for the market. It's you have a lack of details, and some things seem subjective. And I mean, this brings us to one of the key lessons when it comes to trading financial markets. And I've said this before, and I'm sure at least a few of you have said the same thing in one of these past webinars at Epic Street, whether it's my webinar or another webinar. And it's that markets hate uncertainty. Markets hate uncertainty, and by some measures, you could argue that there's still uncertainty about what exactly are these European leaders trying to do, or uncertainty about whether what's been implemented or what's been agreed to will actually even work. I mean, that's the thing about when you have a financial, in the wake of a financial crisis like this, you could argue by some measures the U.S. did way more than it had to, but and that's the thing when it comes to a so-called big bazooka solution. The thing that ultimately calms markets, or at least has in recent times, has been a solution or a financial backstop so big there's no mistaking it. It's going to calm the markets. We just don't have that yet. And of course, I can list a whole number of other things that fuel that all that uncertainty in Europe. But just like some of you living in Europe can probably cite and describe some of the things even better than I can. So anyway, that's what we have. Let me go to the Euro charts here. I've got an orange trend line going back to last Friday's low and a higher low achieved in, this would be late New York morning session on last Friday. You could also look at last Friday's high. See where I'm going with this? During the early part of today's Asian session, yeah, you had a shot short there. In fact, I believe it was our chief currency coach, Will McDonald, who was filling in at FX Bootcamp for our typical Asian session coach, and I believe it was that opportunity that he talked about. So that was one opportunity. By the way, I don't know how many of you look for such things, like convergence of trend lines like that. I happen to like such things, especially or even at the open of a new session. I find that very interesting. Very interesting setups. And of course, another one, if you look at the, and I'm talking about, setups in the early part of the trading day. I'm going to get to a lot more when it comes to other opportunities. But if you look at swing low and swing high established in Asian session trading today, you see those all around the 33, call it 55, 33.60 zone. And so in that context, it wasn't crazy to take a short around there. Oh, the one I didn't mention, but worth mentioning, established in the New York afternoon on last Friday, right there. Now I'm going to drop this thick horizontal black line because I don't want to suggest that that's been all important level, but I made the line thicker here to just add emphasis to it so you can see it. So that was, of course, in the vicinity of the short earlier today, around 33.50 to 55 to 60 was in the vicinity of the blue trend line as well. But let me get to, I want to get to some other opportunities on other pairs. I mean, you can see it's been a steady drip down for the euro. And sometimes, at least I find this, and maybe I'm alone in this, but sometimes I find on days like this, and there's been plenty of days like this on the euro over the past several months here, when it's just a one-way street. Sometimes one way up. Today it was virtually a one-way street down. When you get in this case of a down move like this, the pullbacks are shallow. I should explain that. What I mean by shallow pullbacks, I don't have room to employ the marker on HotCom. Someone describe it to you verbally. Maybe I can go to a chart and to give you a contrasting comparison. Okay, I got one. I'm going to label two pullbacks in the context of this of a sell-off starting in mid-November. Okay, so I've got one rally in the euro, one so-called pullback in the context of this drop from the mid-November high. I got one labeled number one. Pretty intuitive, huh? I've got another pullback I'm going to label here in a moment with the number two. All right. So you should see a 1 and a 2. A 1 and a 2 in my charts. What I'm saying is this. Hello, AT. Can I call you AT? What I'm saying is that pullback number one is, I don't like the word deeper in the context of a downtrend, but that's what I think about it. I'll put it another way. Pullback number 2 is shallower than pullback number 1. Does that make sense? Do you see what I mean by that? Pullback number 1, when I say a pullback, in this context, it's a rise in the context of a recent downtrend. Pullback number 1 is deeper than pullback number 2, or said another way, pullback number 2 is shallower than pullback number 1. So let's get back to my 15-minute chart. So you have days like this when there's reason to believe based on prior price action and also based on news flow or fundamentals. When you just again in this case you have just nothing good happening. There's risk off across the board in terms of the multiple financial markets, not just the euro dropping, the dollar rallying, but you have the European government bond markets, a lot of yields rising in a lot of countries. This was soon after this the European Union Leaders Summit, when we've seen in response to past summits selling soon after the summit. So anyway, there's a number of reasons to believe that the aggressive selling on the euro could have been aggressive today. Well, when you in a context like this, when you get relatively shallow pullbacks, I mean the pullbacks are fairly shallow and the selling just continues. I personally find it can be difficult to short this. I truly find myself I truly find it can be challenging at times unless you're that convinced that this is going to be a strong sell-off in response to whatever, some sort of news or new sentiment or something. It can be challenging for some traders to take these shorts. These shorts, I don't show them now, but sometimes these shorts are logical as they come back to the 15-minute 5 EMA or hourly 5 or something like that. But sometimes they don't. I can show you a chart with indicators in a moment, which can show you that sometimes we didn't get pullbacks to the things like the 15-minute 5 or the 15-minute 21 EMA. In fact, if anything, these pullbacks today, and this is the 15-minute chart for the euro, these pullbacks today, if anything, have gone back to the 15-minute 8 SMA, which I don't know about you, but I don't make a regular habit of shorting at the fifth or long, for that matter, at the 15-minute 8 SMA. I mean, it seems to provide a source of dynamic support or resistance sometimes, but it's not something I see on a regular basis. So here's the point I'm driving at. What do you do? What do you do in this case? If you have reason to believe, and this, I guess, part of this requires an understanding or at least some speculation that the recent news, in this case, what happened with the summit in Europe late last week. If you had reason to believe that the euro could resume its selling, the market could resume euro selling pretty aggressively based on disappointment with the outcome from late last week, then what you could do is either be aggressive yourself with seeking opportunities to sell the euro. Look for overbought Stokes on shorter time frames or such, or what you do is, given the prospect of a dollar rally as the euro is being sold off, you could look for to pair up the dollar with another currency, another major currency that isn't quite as weak. Now, that might sound counterintuitive. I mean, I'm sure to at least some of you, and it sometimes even does to me sound counterintuitive that, why wouldn't you want to match up strong versus weak? A strong currency, in today's case, the U.S. dollar, with the weak currency, in this case, the euro. Again, yes, you can do that. You can do that, but you have to make a conscious decision to be, a little more aggressive than what you may be accustomed to when it comes to, in this case, shorting pullbacks, taking shallower pullbacks and expecting the selling is going to continue. Another way to do this is to pair up the dollar with a more neutral currency. Sometimes even you want to pick a slightly firmer currency than neutral. A firmer currency that can help give you logical technical pullbacks that you can then short. Well, one example of a currency that I saw today that was seemed like a cleaner technical setup for pairing against the dollar for a long on the dollar was the Canadian dollar. Let me take you to the dollar CAD charts. Actually, I'm going to go back to my market overview, and the setup I'm going to show you is I want to explain to you how clean technically it was, and it setup came together at a time of day when it's logical for our London session move to extend. Let me get this Euro chart out of the way. And the chart I got in mind, I've got some markings on it from my discussions earlier, is a dollar CAD. Let me remove some of this stuff, and I'll add it later, so I don't feel like I'm cheating on you or removing some stuff I don't want you to see. Oh, first thing I want to highlight. Let's get a blue arrow, or red arrow going here. You may notice these are 15-minute candles. You may notice a couple lows I've highlighted with red arrows. Those lows established very close to the 1.0225 level, which I've represented with a horizontal black line. And look at the timing of those lows. Those lows established soon after, about the first hour of today's London session. So pre-London, dollar CAD, again, the broad dollar rally, euro selling off, yada, yada, yada. Pre-London, we see the dollar CAD rise above this line, this horizontal black line at 1.0225, retest it, we take off. Now, when you see price action like this, at least when I see price action like this, I'm always looking for clues from longer-term charts. I'm wondering, if price is respected in today's early part of today's London session, this 1.0225 area, I wonder if this area has some history to it. I wonder if this area has a history of influencing price action on this pair. So that's when you go back to like a 4-hour chart or daily chart, and bingo, look at this. In the middle of this 4-hour chart, if I can grab this arrow, you've got a high here from, let's get the date right, that would be December 1st. December 1st high was that day. So then you scale out more to a daily chart. And wow, look at that. Look at the number of highs established in the early and middle part of last month around 1.0225. Actually, I think I had this on a 4-hour chart. I think what I did is I zoomed down on a 4-hour chart a little more. There we go. Yeah, that's what I showed or I discussed. This was one of my mentories today. So you see some notable highs on this 4-hour chart. Look at this 4-hour chart zoomed out to price action from late October. So yeah, you've got a level, again, that's got some history to it and which seemed to have briefly influenced price action in the early part of today's London session. So let's get back to that 15-minute chart. So 1.0225 level has some history to it. It affected price action earlier today, soon after London open. And then you can apply a fib study to the move up from today's early Asian session low to the London session high. And bingo, you got a 50% fib retracement level sitting very close, just a smidge above 1.0225. That, and I'll put a couple arrows there for emphasis. That was a logical long. So AT, did you get that? Shallow versus deep. Now you can use whatever language, whatever label you want on it, but that's the way I like to think of it. A shallow pullback versus a deep pullback. Now I'll admit, shallow pullbacks, if you've got a mind for taking them, if you've got the mindset to expect it, for reasons to expect a strong move, I mean that's the ideal. You want, if you can get yourself into a position along on a shallow pullback. I mean, think about it. A shallow pullback is indicative of a very strong trend. But if there's some days when that could be a shallow pullback, it may be difficult, if not impossible, to identify reasonable or conservative or clean, what I call clean-looking setups, technical setups, to take a long or short, whatever the case. Well, in this case, you had the Canadian dollar not as weak as the U.S. dollar, but in general, the dollar CAD was trending in the same direction as Euro USD was, again in the direction of dollar strength. And in this case, you had you had some history. Oh, the thing I didn't mention, I had the line earlier on here to connect the today's Asian session higher lows. You got a trend line near there as well. So 50% fib, arguably an intraday trend line, and retest of the 1.0225 area, which has been important in the past. Now, it wasn't huge pips there. Today's dollar CAD high, I believe, around the daily M4 pivot point. Let's check that now. Going to the dollar CAD charts with indicators, including pivot points. Oh, interesting. You've got a weekly R1 in the way in the area as well. But what I was really focused on was a daily M4 pivot point. I've got a daily M4 pivot point at 1.0280. So to the math there, you're long maybe just north of 1.0225. Take profit 1.0280. Not a huge trade, but I mean, very logical trade. A very logical trade there. Very logical technical setup. Notice, by the way, I want to go to my euro charts. Notice, by the way, where the euro has established a bottom. Of course, the official trading day isn't over. We're in the New York afternoon now, and certainly this euro sell-off may possibly continue. But I couldn't help but notice on my 4-hour chart with weekly pivot points, I've got a weekly S2 pivot point at 1.3178 or 79. Let's round up and call it 1.3180. So roughly 1.3180 weekly S2 pivot point. Folks, it's pretty rare. It's pretty rare for any major currency pair to reach a weekly S2 pivot point on a Monday. It happened today. Now, part of the reason this can happen is you have some weeks when the trading range in the prior week is rather small, and at least relative to the normal volatility on a given week for a given currency pair. And in those cases, the pivot points, the weekly pivot points in this case, can be a little narrower, a little closer together. And so in that context, it's certainly possible to reach a weekly S2 early in the week, like on a Monday. And that could have been a factor this week. But anyway, it's not at all that often you see a weekly S2 hit on a Monday, and a weekly S2 always a prospective, at least temporary, source of support. And thus far, today's low seems to be defined by the weekly S2 almost to the pip. And let's put this move into context as well. Going back to I might have to go to a daily chart for this. Yeah, on my daily chart, this chart's a bit marked up. If you can see in the lower middle portion of the chart, my cursor hovering next to the low from early October, and we are not too far from that. Not too far from that. So that defines today's moves and the I guess you might say the circumstance that set it up. It wasn't, by the way, just Fitch that made the comments that posted the statement in the latter part of today's New York morning session. There were some comments earlier, which I'll have to go back and check. I believe it was Moody's. Moody's weighed in earlier today as well. Moody's, again, one of the three primary ratings agencies. Scrolling back and trade the news for the Moody's comments. Where is it? Moody's. Here we go. Yeah, Moody's weighed in with a statement during about the middle part of today's Asian session. Moody's, the ratings agency, said that the EU summit. The communication from the EU summit offers few new measures as crisis remains in critical and volatile stage. Risk of a negative European sovereign ratings action in coming months. Now, these ratings agencies, as many of you know, do have different perspectives, probably different ranking, different ratings criteria, and maybe who knows, maybe some of them are unduly influenced by different parties and such, but. my point is this: they don't always work in sync. I mean, so one ratings agencies can downgrade a sovereign, for example, much sooner than the others. And arguably, the focus right now is on S&P, who issued the negative watch early last week, was last Monday specifically, on multiple Eurozone countries. They're the one in the spotlight, but you could argue it's not helping the euro today that we have other ratings agencies weighing in and expressing some concerns about the prospects for Europe. So what now? Yeah, very political, I know, Gam. Well, here's what I would be curious about. Let me go back to the daily chart. I just mentioned we recently reached the weekly S2 pivot point, a source of support. It's possible we go a little lower before the end of the day. I've got about 1.3150, not quite that, but near 1.3150 for the October 4th low. So here's what I'm pondering. Weekly S2 pivot point, the October 4th low near midpoint psychological level. I don't know if it's going to be later in the New York afternoon or closer to the Asian Open, but what if the euro essentially at a double bottom with the October 4th low in the early part of today's Asian session? It seems possible to me that the Asian session traders will choose to buy up the euro, choose to, in other words, sell the dollar. Wouldn't surprise me at all. Now, you can trade that if you like, if it happens, if the setup comes together, or you may choose to ignore, given the recent price action, and certainly given the recent trends since late October here. You can simply ignore any rally, even if you expect a technical rally, and seek only to short this pair. And I don't know if it's going to happen or if it's going to happen or when it's going to happen, but if we can make a sustained break below this early October. What does that bring up next? Let's see if I can dig up another chart, a little cleaner. Well, this wasn't a good choice. Not the most cleanest of charts. Yeah, but if we break that early October low, I mean this brings into play. It would seem certainly 130. And I've got to think plenty of traders, hedge fund managers and the like are wondering about is this the beginning of the trip that takes us to the mid-year lows from last year, the initial lows in response to the Greek sovereign debt crisis. Certainly possible. I don't know about you, but I've been reading a lot about different entities, be it banks, be it clearinghouses and so forth, preparing for an eventual, call it unraveling of the euro. Be it some countries leaving the euro, or simply a major tanking of the euro, the common currency. Now it may be all for naught. I mean, maybe something be it other factors such as the U.S. policy or Fed policy or something else that's going to fuel a sell-off on the dollar that gives a boost to this pair. But it's certainly something being discussed, and being let's put how I put it in a quant terms. There's a non-trivial possibility that the euro at some point in the coming weeks it's on its way south pretty quickly. Hey, thanks Dan for the heads up on Alliance. AT, I do not post those. No, AT, there's there are plug-in files available on several sources. Actually, it was one of my former students who provided to me anyway the plugin files for these pivot points you've seen on my charts. And I'll tell you what, if you want anyone who wants those pivot point plugins, feel free to email me. Template as well. Same for the template, AT. If you want a template for the setup of my charts, you can acquire that as well. So there's about 8 minutes of scheduled time left in this webinar, and the first point I want to make is as I'm pondering the time of year we're in, we are entering a time when markets could get thinner. Now, what do I mean by thinner? That means fewer buyers and sellers, simply fewer traders in the market. Some days that can mean for fairly low volatility when the pairs like the euro just don't move very much. Other days when you have maybe news provides a catalyst of some kind. Other days you can get some notably exaggerated moves on even pairs like the euro during this time of year as we approach the end of the year and fewer buyers and sellers, simply fewer traders in the markets. That is a possibility. So it seems kind of odd to think of it that it works that way, but it truly does work that way. In a thin market, you get either one of two extremes. Either the market doesn't move much at all, or if there's some sort of catalyst or spark, and the traders that are in the market, enough of them decide to push the market in one way, you can get some notably exaggerated moves. So be warned that that's a possibility that we all face really for like the next month. Maybe close more so around the end of the year than any other time. But over the next month, there's a real possibility that we could see some varying conditions, exaggerated moves followed by very low volatility. I was pulling up FX Street's calendar to look what's on the calendar tomorrow. I know one thing's on the calendar for tomorrow, and I don't know that it's really going to move the market this time around tomorrow that is, but the next FOMC meeting I expect could move the market. Now, what the market is probably going to look for tomorrow. Well, let me back up here. So, the U.S. Central Bank is the FOMC, the Federal Open Market Committee. Their next meeting is tomorrow, and their next policy decision will be announced after London close tomorrow. So this would be about 2:15 p.m. New York time tomorrow. This would be early evening for most of you in Europe. Now, is the Fed expected to do anything meaningful? I would guess no. Is the situation one where the Fed would do nothing? Well, not necessarily. It's within the realm of possibility that the Fed could do something. I kind of doubt it though, for a couple of reasons. I doubt that they would do anything tomorrow. Number one, the Federal Reserve, the FOMC specifically, just announced, this was September 21st, I believe it was. I may be off by a day or two, but sometime around late September there, second half of September, they announced what's called Operation Twist. What they're doing, and what the Federal Reserve is essentially doing is, the Fed has a portfolio of assets, of holdings, and especially U.S. Treasury securities. The Federal Reserve announced on September 21st, again, I'm pretty sure that's the date, their intent to sell shorter-term Treasury securities, such as bills, shorter-term bills, and trade those for longer-term Treasury securities like notes and even especially bonds. So they're essentially lengthening the maturity of the average maturity of their Treasury security holdings, and that's it's one means of they can bring down longer-term rates without adding a great deal of added level without raising their overall asset levels. That's what they're doing. So again, it's a sort of a rather mild thing for them to do compared to the quantitative easing programs they pursued in the past. And my point is this: that announcement being so fairly recent, and I believe their Operation Twist program runs through So they're going to be rotating some $400 billion worth of Treasury securities from shorter to longer-term denominations over the course of the next several months, I think ending in June of next year, as I recall. So given the recency of the announcement, given the longevity of the plan that goes through mid-next year, I would suspect the Fed's going to stand pat and do nothing. Now, as I said earlier, given the situation in Europe especially, and even given some of the recent inflation measures which are tapering off a bit, and of course there's just the job growth in the U.S. is just still relatively pathetic. I mean, barely enough to keep up with population growth at that. So there may be a growing case over time for more quantitative easing. And here's the point I'm driving at. Given the recency of the Cooperation Twist announcement, they're probably not ready to do anything yet unless things get worse. Now, the other reason why they wouldn't do anything yet, I'm guessing, is because the FOMC voting members are still a bit on the hawkish side. Now, what do I mean by that? So, hawks versus doves. Real quick explanation there. When you have central bankers are members are key people at a central bank are commonly grouped into divided into two groups. You got your hawks, you got your doves. Your doves are less concerned about future inflation, more concerned about economic growth. The doves essentially want to lower rates or the equivalent of that. And the doves have been the ones that the Fed have pushed for and have gotten these various quantitative easing programs and some of these other easing programs. The hawks and examples of examples of doves. Janet Yellen, formerly of San Francisco Fed, is one of the notorious doves at the FOMC. The hawks. A hawk is much more concerned about longer-term inflation to the point where a hawk doesn't want to do any more lowering rates, or the equivalents would be these quantitative easing programs where the Fed acquires Treasury securities to bring down longer-term rates. The hawks, like Richard Fisher of the Dallas Fed, like who's the guy at Plosser at the Philly Fed. These guys want the Fed to think the Fed has done more than enough, and they're concerned about the inflation in the long run, just overwhelming the U.S. financial system, and of course the U.S. economy. So the hawks don't want to be doing any more easing. The doves may be open to doing more easing if it's deemed necessary. Now, if you look at the voting members of the FOMC, there's a certain group that remains a voting member or year in and year out. Federal Reserve Chairman Ben Bernanke is one of those voting members that will always be a voting member. Then you have another group, you have a group that's going to rotate out of voting members, and that group is this year is fairly heavily hawkish. So what do you mean by this? The makeup of the FOMC voting members is going to shift quite a bit from a bit on the hawkish side to a bit on the dovish side. So you're going to have more doves amongst the voting members of the FOMC starting next month. And the notorious hawks who were voting members this year, they're out of the picture. They've served their time as a voting member, and they're going to rotate out for a year, maybe more in some cases. So the Fed, as of early next year, as of next month, is going to be have a more dovish makeup when it comes to the voting members of the FOMC, and because of that, might be more inclined to pass or approve more quantitative easing, some form of like a QE3 program. Now, even so, that they need to be able to justify the conditions, the case for doing so, and that may take time, that may take more worsening economic data to just justify it. But it's a possibility. It becomes more of a possibility next year for the Fed to launch QE3, given the shifting musical chairs, if you will, at the FOMC. And I realize it's 1:45 p.m. New York time. So here's what I'm getting at. I, for one, am curious as to what hints, if any, the Fed might drop about in their statement tomorrow regarding further easing. Are there going to be any conditions under which they could consider further easing? Probably not, but I don't know. I'll certainly be looking myself. Now we may not get any meaningful clues from the Fed until, what would this be? Either late this year, early next year, whenever the the next FOMC meeting minutes come out. I'm not sure. I'm guessing that's by the end of the month, but it's often before the end of the same month where the FOMC had their meeting. But in this case, it may be like early next year. But whenever the next FOMC meeting minutes come out, the minutes of the meeting being conducted tomorrow at the FOMC, that might be even more telling than the statement issued by the FOMC tomorrow after London close. Statement's going to be prepared, and it's going to be a little more concise and brief and lacking in details, whereas the meeting minutes released some 2 or 3 weeks later might be much more revealing in terms of showing the Fed's hand if there's anything to be shown regarding what the Fed's next move may be. There may be no clues, either the statement or the minutes. We'll find out. And let me see what else I may have missed. Checking FX Street's calendar. Many of you know the markets haven't responded a whole lot to U.S. economic data. Oh, you know what? I want to mention one more thing. Something worth watching. I'll talk about it in more detail at tomorrow's webinar. Something I noticed, and I'm not the only one who's noticed this or pointed this out, but I certainly noticed it during today's Asian session. China's currency, what do you call it, the yuan? China's currency, or the yuan, I'm struggling with the pronunciation there still. China's currency has dropped, let me back up for a minute. China's currency is allowed to trade within a fairly narrow band of about 0.5%, about 0.5% each day. So the moves of the China's currency in relation to the dollar are limited. It's not allowed to range freely, but it's allowed to trade in a limited range each day. Well, China's currency has dropped by the maximum allowed daily limit of 0.5%. Each of the, let me make sure I got this right. I want to get you the number of days right. I believe it's in the last 9 days. I'm going to check some of my news here to confirm that. Yeah, the China's currency has dropped against the dollar by its 0.5% daily limit for 9 straight days. 9 straight days. Pronounced yuan? What? I need some help in that. I remember I'm from the Midwestern part of the U.S. and my pronunciations of anything remotely foreign leave a lot to be desired. I'm not my best at that pronunciation, so I need some work on that. So what does that mean? Well, is this some maneuvering by the People's Bank of China, the China Central Bank, to weaken the nation's currency to help its exporters? Yeah, that could be certainly part of the story. I'm wondering if at least part of the story there is money flow out of China, be it flow of foreign investors pulling money out of China, or even some money from China going overseas. Anyway, it's notable, and there's been some clues from various economic data that China could be in for at least a little more than your typical run-of-the-mill cyclical slowdown. It is a real possibility. So keep that in mind. And let me check tomorrow's calendar. UK CPI due out during tomorrow's London session. I just haven't seen much data out of the UK move the market recently. U.S. retail sales, that could certainly move the market. And then, of course, the FOMC decision and statement. So there you go. Look out if maybe I don't have high hopes, but maybe the UK CPI data gives the pound a bit of a spark one way or another. I'd want retail sales could add a little volatility as well. But FOMC now, I wouldn't look to trade FOMC, and we'll talk about this in about 23 hours from now when I start my next webinar here at Epic Street. But maybe FOMC helps set the tone for the next trading day for Wednesday. Yeah, Dan, I see your comment about what they're saying about inflation and such. Yeah, Gam. So that's part of what I'm talking about there. That it may be money flow for more than one reason. One of the reasons being some of those with money in China are actually shifting money out of the country. And that doesn't bode well. So before I have to here, and by the way, I run past my time, and my apologies again to Epic Street and everyone else who expected me to end this about 7 minutes ago. I'll end with this point. If China does slow more significantly than some think, what does it mean for the currency market? Well, certainly there's the risk-off thing. Dollar could have eventually gain further strength, and especially as more money flow comes back into the U.S. Some U.S. investors and funds and such have invested in China in different ways. In terms of other currencies, well, let's face it. I mean, the Australian dollar. Australia is pretty heavily dependent upon the health of the Chinese economy, and if China's slowing down, there's going to be less demand for commodities, and China certainly acquires a significant portion of its commodities from Australia. So a weaker Aussie is a real possibility moving forward. That is, if we see further weakening of the China economy, especially more weakening than what the market currently expects right now. Folks, again, thank you for your time. Thank you especially everyone at Epic Street for making this event possible. We'll do this again tomorrow in about 23 hours. Have a great day. Cheers.